Welcome back to another Options Flow educational video. Today, let's talk about identifying and tracking the whales that come up in our Options Flow feed. Let's define a whale as a trader who makes very large trades. Trading Options Flow is all about identifying these whales as they enter their positions. If you decide to follow a whale into a trade, it'd be prudent to know if they're still occupying the position. Even if you decide to play the trade your own way, you should still be able to track the whale. Here's a look at the options volume chart for some Palo Alto weekly calls that I saw hit the tape in the morning hours of Wednesday's trading session. About 1,300 contracts traded at the ask. Let's give this trader credit for about 1,300 bought calls at an average price of around $4.25. Side note, just because contracts are moved at the ask, it doesn't necessarily mean that they were bought. Here's a look at the entire day's activity for this contract. Around 2,700 total volume. We gave the trader credit for 1,300 bought calls, and there just so happens to be about that much volume in bid-side call activity. For the purposes of providing a basic example for someone learning about this subject matter, this is a pretty clean look at a morning buy followed by an afternoon sell for some modest gains. Let me circle back and add that all this analysis is really only made possible by the fact that we are dealing with contracts that have relatively high volume and low open interest. High volume and low open interest are two characteristics that, when combined, may be indicative of unusual options activity. These are 2 points that I stress often. A link to these tweets and all others referenced in this video will be in the description below. I mentioned a minute ago that just because contracts are moved at the ask doesn't mean that they were necessarily bought. Let's rewind to Monday, November 14th. Here's a midday look at the weekly XLP 73 strike puts. We can see about 37,000 volume between 10 a.m. and 11 a.m. PST. So it looks like we're dealing with about a 37,000 contract large whale here. Here's a look at the same chart encompassing the entire day. By the end of the day, there was 43,000 volume. Just by raw numbers alone, there was no way for a trader to enter 37,000 puts and exit the entire position the same day. So we're going to monitor the position and see what they do next. Right at the open Tuesday, there was coincidentally about 37,000 contracts traded. A large portion of them were moved at or closer to the ask. The volume lines up perfectly with the whale. So they either doubled their position or closed out. A closeout seems like the more likely of the two options. And you can see by the next day, Wednesday, if you lost track, that the open interest has dropped significantly, letting us know that the whale did indeed close their position on Tuesday. The top half of your screen shows the whale entering their position Monday, and the bottom half shows the exit. There is a large portion of their exit that occurred closer to the ask, a fill of 24 cents per contract on a 22 to 25 cent bid-ask range, but as previously mentioned, the reduction in open interest the next day confirms that they were indeed selling their contracts. As far as the trade itself goes, the whale entered at around 35 a contract, didn't sell when they doubled the same day, and then sold at a loss when they could have held longer and saw a positive return. So maybe a topic for another video, but it's sometimes refreshing to remember that even big money doesn't have perfect execution. So to recap, our two previous examples were an intraday scalp with a clear ask side entrance and bid side exit, and an overnight trade using volume to identify the whale's activity. Our last example will be something of a hybrid of the first two. Here's a look at some SPY flow from Thursday, November 17th. At 9:35 a.m., we saw an extremely high volume of same-day expiration out-of-the-money calls, over 27,000 contracts traded, nearly all at the ask. The contracts were not purchased in one single lot, as evidenced by the numerous buys over the course of a minute or so, but this kind of subsequent buying can generally be attributed to a single party. So let's estimate and give this trader credit for about 27,000 contracts at 97 per. Here's what it looks like if we shift over to the options volume chart a few minutes after the transactions. Our estimated 27,000 contracts visible in the chart. Here's the chart in its totality throughout the day. The large candle at around 1 p.m. caught my eye. After looking at the feed, I surmised that the trader had exited most, if not all, of their contracts at this point, at around 186 a contract, nearly a 100% move intraday. If we're using strictly volume here to track the whale, the thesis makes perfect sense given that there is volume to accommodate it. Given that this was a same-day expiration contract, there is no next-day open interest value to reference. I generally don't follow same-day expiration flow, but this SPY flow paid off handsomely. Just to throw in a chart in which there is no obvious whale that can be tracked, here's a look at Friday's activity for an at-the-money Tesla call expiring next week. With lots of volume occurring at every interval, it would be extremely hard to track transactions with any accuracy. As a reminder, the market is closed Thursday, November 24th for Thanksgiving. The market will be open on Friday but will close early at 1 p.m. Eastern. Thanks for sticking around to the end of the video. As always, I hope that you are able to take something tangible away from these quick videos to assist in your trading endeavors.